I've spent nearly 7 decades watching people quietly wipe out their retirement savings, and the pattern is always the same. They believe that staying safe means avoiding risk entirely. It doesn't. Real safety comes from knowing exactly what you own and understanding the reason you own it. Most retirees mistake comfort for protection. They choose things that feel secure instead of things that actually protect their future. And those two are not the same. Take a certificate of deposit, for example. It feels reassuring because the balance barely changes. But when it pays 3% while inflation eats away at 5%, your purchasing power is shrinking day by day. You're becoming poorer very slowly. That isn't safety. That's quietly moving backward while pretending everything is fine. Let me be absolutely clear. There is no such thing as a completely risk-free investment. Anyone claiming otherwise is either misinformed or trying to sell you something. What truly exists are smart compromises. You can exchange growth for stability. You can sacrifice easy access to your money in return for higher income. You can choose simplicity over complexity. But you cannot have maximum safety, maximum returns, and instant liquidity at the same time. Reality simply doesn't work that way. When people ask me to name the safest investments for retirement, they're usually asking the wrong thing. They want a list of products, but products don't protect you. Clear thinking does. I could hand you the 3 best investments in the world, and you could still lose everything if you panic at the wrong moment or chase returns at the wrong time. So before we talk about what to own, you need to understand this truth. The greatest threat to your retirement isn't the market. It's you, your emotions, your impatience, your desire to outsmart everyone else. Those destroy more portfolios than any economic downturn ever has. But if you can manage yourself, if you can stay calm when others are rushing for the exits, if you can remain steady when fear is shouting in your ear, then these 3 investments can work in your favor. Not because they're magical or exciting, but because they're built for endurance. They won't make you wealthy overnight, but they can help ensure you don't end your life struggling financially. And in retirement, that's the only objective that truly matters. The first investment every sensible retiree should hold is so dull that most people reject it immediately. They crave excitement. They want fast growth. They want to feel busy and clever. What they actually need is the financial equivalent of a utility company. Reliable, consistent, predictable, completely unexciting, almost painfully boring. I'm talking about dividend-paying stocks from companies that have endured every major crisis you've personally experienced, and several that happened long before your time. Not just any dividend stocks, but businesses that have raised their payouts year after year, sometimes for generations. These are known as dividend aristocrats, and they stand for something many investors have forgotten: discipline. These companies don't hand out dividends only when everything is going well. They continue increasing them, even when conditions are terrible. During the 2008 financial meltdown, while banks were failing and commentators were declaring the collapse of the entire economic system, companies like Coca-Cola and Procter & Gamble kept lifting their dividend payments. Not out of generosity, but because they were able to. They had built resilient businesses that produced steady cash flow in both good times and bad. That's what retirees actually need, not speculation or hype, but income that continues even when the news becomes frightening. Many people mistakenly believe safety comes from stable prices. They want stocks that barely move. That's the wrong focus. True safety comes from dependable income. I don't lose sleep if Coca-Cola's share price drops 30% in a given year. What matters to me is whether those dividend payments keep arriving, and they will. People don't suddenly stop drinking soda during recessions. They don't quit brushing their teeth or washing their clothes. Human habits remain surprisingly consistent, even when financial markets are chaotic. That kind of reliability is far more valuable than any growth stock promising to double your money someday. When you invest in dividend aristocrats, you're placing your trust in something solid. Human behavior. People will continue buying the same essential products they've relied on for decades. That doesn't change because an election happens or a central bank adjusts interest rates. The real advantage of dividend-paying stocks is that they solve two critical problems at the same time. First, they provide income without requiring you to sell your shares. That's incredibly important in retirement, because selling during a market downturn permanently locks in losses. When you live off dividends, you don't have to sell anything. You simply collect the income and wait for markets to stabilize. Second, dividends offer psychological support. When markets are falling and panic is everywhere, it's much easier to stay composed when money is still being deposited into your account. You're not just staring at a fluctuating number on a screen. You're receiving cash. That difference often determines whether someone remains rational or makes emotionally driven decisions. Of course, some people will point out that dividends are not guaranteed. And that's true. Yes, dividends can be reduced or eliminated. That's a reality. But the aristocrats, the companies that have increased their payouts for 25 or even 30 straight years, don't make that decision casually. Cutting a dividend would severely damage their credibility, and credibility matters more to them than short-term profits. These companies have built their entire identity around reliability. That isn't a branding exercise. It's a long-term survival strategy. Take Johnson & Johnson as an example. They've raised their dividend every single year since 1963. That includes the Vietnam War, the stagflation era, multiple recessions, the dot-com collapse, the global financial crisis, and even a pandemic. If you had owned that stock during retirement, you would have received steadily increasing income through every major crisis of the past 6 decades without losing sleep at night. Now compare that to chasing the newest technology stock or the latest cryptocurrency trend. Yes, you might strike it big, but you might also wipe yourself out completely. In retirement, that kind of risk isn't acceptable. You don't have the time or income to recover from a major mistake. That's why boring investments win, not because they're thrilling, but because they're durable. I've said this for years. The best investment portfolio is the one that allows you to sleep peacefully. Dividend aristocrats do exactly that. They aren't flawless. Their share prices will drop during bear markets, just like everything else. But the income continues. And it's income that pays your bills, not stock prices flashing on a screen. If I were building a retirement portfolio from the ground up, this is where I would begin. Around 40 to 50% allocated to a diversified group of dividend aristocrats. Not just one or two, at least 10 to 15 companies spread across different sectors. You want consumer staples, healthcare, industrials, businesses that produce necessities, not luxuries people only buy when they're feeling confident. This strategy isn't about getting rich quickly. It's about staying financially secure. And the most reliable way to do that is by owning pieces of companies that generate cash no matter what the economy is doing. That's the first pillar. Income that keeps flowing even when markets fall apart. There's also something about dividend investing that rarely gets discussed. It's not just about the money. It's about mindset. When you're 70 years old, markets are collapsing, and every commentator on television is predicting catastrophe. You need something solid to rely on. Not hope, not forecasts, not guesses. Something tangible. A payment that shows up every quarter, no matter what the Dow Jones did yesterday. That's psychological protection. I've seen retirees with flawless-looking portfolios panic and sell everything simply because they couldn't handle the emotional stress of watching their account balance swing up and down. They had no anchor, nothing reminding them that the companies they owned were still operating, still selling products, still producing profits. Dividends provide that anchor. Every dividend payment is confirmation that your original reasoning still holds. The business is generating cash. Your retirement doesn't depend on finding someone else willing to pay more for your shares. You're being compensated for ownership. That's real. That's durable. And that's what allows you to sleep peacefully while everyone else lies awake, worrying. Now let me clear up a common misunderstanding. People look at a stock yielding 2 or 3% and say, "That's not enough to live on." They're correct, but they're missing the bigger picture. The yield you see today is only the starting point. What truly matters is how that yield grows over time. If you buy a stock yielding 3%, and the company increases its dividend by 7% annually, 10 years from now, you're earning roughly 6% on your original investment. After 20 years, it's closer to 12%. That's the real power of dividend growth. Your income rises, while your initial cost stays the same. Now compare that to bonds. Buy a bond paying 4%, and you'll receive 4% forever. No growth, no real protection against inflation, just a return that slowly loses purchasing power over time. Dividend growth stocks, on the other hand, provide income and inflation protection at the same time. Strong companies raise prices. When they raise prices, they can raise dividends. You're not battling inflation, you're benefiting from it. That's why I've always favored stocks over bonds for retirees. Yes, stocks fluctuate more. But volatility and risk are not the same thing. Volatility is short-term price movement. Risk is a permanent loss of capital. If you're not selling, volatility doesn't harm you. It's just background noise. Inflation, however, hurts you daily, whether you notice it or not. Another powerful advantage of dividend aristocrats is that they naturally filter for quality. To raise dividends year after year for 3 decades, a company cannot behave recklessly. It can't overload itself with debt. It can't make careless acquisitions. It has to be disciplined. Because once a dividend is cut, its reputation collapses, investors leave, and the stock price suffers badly. As a result, these companies are structurally conservative. They build cultures around careful capital management and long-term thinking. And that's exactly what you want in retirement, not businesses taking wild risks and swinging for the fences. They're not trying to win big. They're designed not to lose. And there's another advantage that's harder to measure, yet just as critical. Dividend aristocrats typically operate simple, stable businesses. They aren't trying to disrupt industries or reinvent society. They sell everyday essentials: soap, toothpaste, beverages. That may sound dull, but dull businesses endure. Flashy, revolutionary companies often don't. I've watched countless game-changing companies vanish over the years, but I've never seen Colgate-Palmolive disappear, because brushing your teeth doesn't suddenly become optional. That level of predictability has real value. When you're 75 and relying on your investments for income, the last thing you want to worry about is whether the companies you own will even exist a decade from now. You want businesses with competitive advantages so wide that even poor management couldn't destroy them overnight. Consumer staples offer that. Healthcare offers that. Utilities offer that. These aren't engines of rapid growth. They're systems built for survival. And survival is the priority in retirement. Now I can already hear the objections. What about technology? What about innovation? Shouldn't retirees invest in the future? No, retirees should invest in the present. Younger investors can afford to bet on what might happen next. They have time to recover if they're wrong. You don't. That doesn't mean avoiding technology entirely. Companies like Microsoft and Apple are now dividend aristocrats themselves. They've evolved from high-growth stories into cash-generating powerhouses, and that's perfectly reasonable. But buying speculative tech in hopes of finding the next Amazon isn't investing. That's gambling. And gambling in retirement is how people end up needing a job at 75. Stick to businesses you understand, businesses that were profitable 20 years ago and are likely to be profitable 20 years from now. Businesses where competition doesn't completely change every 18 months. That approach may not be thrilling, but excitement comes at a cost. Boring, on the other hand, tends to be profitable. Let me show you how this plays out in the real world. Imagine you retired in the year 2000 with $1 million. You invested half into dividend aristocrats, yielding about 3% on average. The other half you put into technology stocks, because everyone said the internet was the future. By 2002, your tech investments were down 70%. Your dividend stocks were down maybe 20%. But those dividend stocks were still paying you $15,000 a year. The tech stocks paid you nothing, and many of them went bankrupt. Now fast forward to 2024. Your dividend holdings didn't just recover. They continued to compound over time. That same original investment eventually grew into $40,000 or $50,000 a year in income. Meanwhile, the technology stocks had mixed results. A few bounced back, many never did. And even if you managed to choose the winners, you spent 2 decades worrying about whether you had made the right decisions. The dividend-focused investor, on the other hand, simply collected payments and slept soundly. That's the real distinction between speculation and investing. Speculation demands that you be right. Investing only requires that you avoid being disastrously wrong. And the most reliable way to avoid disaster is to own businesses that have already demonstrated their ability to survive nearly anything. So when I say dividend aristocrats form the first pillar of retirement security, I'm not talking only about income. I'm talking about mental calm, protection against inflation, preservation of capital, and the ability to ignore the constant noise of the market, all bundled into one unexciting package. Most people won't follow this approach. They'll chase higher yields from riskier places. They'll buy junk bonds, preferred shares, or complicated income products. Eventually, they'll discover that yield without safety is simply lending money to someone who may not be able to repay you. Don't fall into that trap. Accept a lower yield from higher quality companies. Over a 30-year period, a high-quality, low-yield investment will often outperform a risky, high-yield 1 by 5 or even 10 times, not because of luck or clever tricks, but because of survival and compounding. That's the first investment. Dividend aristocrats. Not your entire portfolio, but the core, the foundation, the part that allows you to rest easy while everything else feels uncertain. The second investment retirees need is even more straightforward, which is precisely why so many people get it wrong. In finance, people distrust simplicity. They assume that if something isn't complex, it can't be effective. That belief is mistaken. The best ideas are usually simple. They're just difficult to stick with because they require patience rather than constant action. I'm talking about index funds, specifically broad market index funds that own the entire market, the S&P 500, or better yet, a total market index, one fund, thousands of companies, no predictions required. Most retirees shouldn't be selecting individual stocks. That's not an insult, it's math. If you don't fully understand what you're doing, picking stocks is no different from gambling. And even if you do understand, you're competing against professionals with better data and faster systems. The odds are not in your favor. But there is an alternative. You can own all of them. When you invest in an index fund, you're not placing a wager on one brilliant company or riding the momentum of a single industry. You're betting on something far more reliable, that people will continue to wake up every day and try to earn a living. That's a bet I'm always willing to take. It has worked for hundreds of years, and there's no reason to believe it won't keep working for the next 100. Index funds are so powerful because they remove emotion from the process. There's nothing to tweak, nothing to outsmart, nothing to overthink. You simply own the market and allow it to do what markets have always done: grow over time, while periodically terrifying everyone along the way. From 1928 to today, the S&P 500 has delivered an average annual return of roughly 10%. Not consistently, and certainly not smoothly. Some years it drops 30 or even 40%, but over long periods it compounds relentlessly. And compounding is the closest thing finance has to magic. It doesn't feel magical while it's happening. It feels dull. But dull is what works. Warren and I have been saying this for decades. Most investors would be far better off buying a low-cost index fund and then doing absolutely nothing. No trading. No market timing. No listening to predictions. Just buy and leave it alone. The problem is that people struggle with inactivity. They want to feel busy and productive, so they trade, switch funds, and chase whatever performed best last year. And every time they do that, they damage their results. The data is unforgiving. The average investor trails the market by several percentage points per year. Not because they choose terrible investments, but because they can't remain patient. They buy when enthusiasm is high and sell when fear takes over. Index funds help solve this by making activity useless. There's nothing to manage. The fund automatically adjusts itself. Your only job is to stay out of the way and let capitalism do what it does. People often worry about market crashes. They ask, what if I invest and the market drops 30% next year? My response is straightforward. Then it drops 30%. If you're retired and covering your living expenses with dividend income, your index funds are there for growth decades into the future. You're not spending that money this year or next year. You're using it when you're 85. By then, every market crash along the way will be a distant memory. The key is designing your portfolio so you're never forced to sell during a downturn. That's what dividend income and cash reserves are for. The index funds simply sit in the background, compounding quietly while everyone else panics. I've watched this cycle repeat for 70 years. Markets fall, people sell in fear. Markets recover, sellers regret it. Markets rise, people rush back in with excitement. Then markets fall again. It's the same pattern over and over. The investors who succeed are the ones who ignore the cycle entirely. Index funds make that easier because there's no single company's news to obsess over. You don't care if one technology firm misses earnings or one